All right, good morning, everybody. So we made it. We're on the other side of FOMC. Now we just move on to the next thing. I was looking up and down the curve, even with the replacement of Powell, with the expectation that uh, the new the new Powell would cut rates, since they would likely be a puppet of the administration. You would think we'd see something priced in, but no, really, it's still nothing on the curve. If you show up on the FedWatch, it's a free website. If you've never been there before, just Google FedWatch and you'll find the CME group. You can see it up at the top, CME group, interest rates, FedWatch tool. It's a free page. You don't need an account. You don't need to log in. And you can see this. And it allows you to check the different FOMC dates to see what the market is pricing in or unwinding in the market. The dot plot, last I knew, had a projection of 2 cuts for this year. The market was pricing in 4. Uh, Not seeing it really, not with any high probability. So that's what you want to continue to look for. Any headline or shift in sentiment that causes the market to come in and really begin to reprice any probable cut or pause, right? That's easy enough to spot when they really start coming in and hammering it out. Otherwise, if it's subtle and it's barely moving, right? Like we got micro percentage differences here. This is not what we're looking for, right? So you'll know it when it happens because it won't be subtle. Which kind of reminds me, somebody was talking about analyzing a stock the other day and was asking for help because it's one of those situations where you could possibly see it as bullish, possibly see it as bearish. If it's that wishy-washy, then it's not much of a trade anyways. I mean, with options we can trade sideways, so there's always that. But I mean, if you're looking for strength and trend and momentum, and you're looking at a chart and you're stuck between, well, I don't know, it might be kind of bullish if you look at it this way, it could be kind of bearish if you're looking at it that way. You don't have strength and conviction and momentum. You've got some wishy-washy trash. Food for thought. Yeah. Looking at what's going on around the world, we are green mostly. Hong Kong is flat and Japan also. Then through the Dow, the Nasdaq, the S&P, and small caps up the most, more than a quarter, less than a half. So it's up a little, not a lot. Still, we're on the other side of the FOMC. We want to make it through the end of the week without giving too much back. We're going to get some jobs numbers this morning. This isn't the big one. There are big job numbers that we want to watch for. It's non-farm payrolls, but this isn't that. So, of course, any jobs data you really want to pay particular attention to. The Fed has a dual mandate. One of those is employment. So, any employment data is worth at least being aware of. The trade deficit, on the other hand, we're seeing a wider and wider discrepancy here. And it is delayed report, which, a lot of our data has been delayed significantly because of the last government shutdown. And the way it's going, we're going to get another government shutdown, January 31st, which is this Saturday, if they don't come up with some solution. And so far, they are wider than ever when it comes to any sort of a solution. So the government shutdown, at least the way things stand at the moment, seems pretty certain. So, you know, really look at what you're holding, know what you own, and recognize the level of risk to your portfolio. It doesn't matter what the chart looks like, right? You're trading Meta, Google, Tesla, whatever. It, looking at that one chart of that one thing that you're trading isn't going to give you insight into how it's going to be affected if we get another government shutdown. So, maybe kind of take profit in some stuff, thin out your portfolio a little bit, reduce risk. We've got auctions in the front end. You could probably just use the IRX, kind of roll them all up together. Once we're through with the morning session, the afternoon looks pretty clear. Not seeing a lot of risk into the afternoon, other than after the close, we do have more Mag 7 earnings. If you was paying attention to the earnings last night, Meta increased the amount of money they're projected to spend. It went from like 110 billion to 130 billion. I mean, what's 20 billion among friends, right? For the year on AI, and they were rewarded for it with a pop to the upside because they were able to show that they're monetizing what they're making. Microsoft, on the other hand, is down. Sales are down. How that's going to play out with Apple is going to be interesting. Apple's going to need to do something about that disgusting thing that they call Siri. There's supposed to be some solutions to that, possibly some announcements in this earnings. But there's also worry about their phone sales and whether or not they're able to meet expectations. So, on the one hand, Apple solving this Siri problem sounds great. How much money they're about to spend to do that, and whether the markets are going to punish them for that, and then their phone sales. That's going to be the two, to me, the two big ones that Apple investors are going to be focused on. It's not new, right? Apple phone sales is always one of the widgets. It's just going to be the spending on the other side of that. All right, coming out of the White House today, we got a high risk for this schedule. We were talking about how the afternoon seemed pretty clear. Yeah, until 4:30. So after the market closes, the president's going to make an announcement. We could see something happen around the cabinet meeting. I don't know how much risk this has, but it does line up with auctions that we have through that 11 and 11:30 time frame. It's still part of the morning session of events that are going to be happening. So I won't count that as part of the afternoon anyways. If we make it through the cabinet meeting without any drama, then when we come out of lunch into the end of the day, should be relatively good. So the only thing that could really pop up in that time frame would be gotcha headlines or some sort of surprise that we can't see coming. Nothing is scheduled anyways. We're looking at 80,000 in the overnight for the volume. The average is 55 or so, 45 to 55. So we're a little heavy. It's not a bad thing. It really just shows that we had participation last night. We had 90,000 yesterday, so being at 80 today, right, just really shows that even though it was an FOMC week, we didn't see a sit out that we normally would. Normally it'd be a lower participation, lower volume, and we just really didn't see that. But it's also not really much of a surprise since even though the Fed is not providing a lot of forward guidance, they did very well with their communication, right? They made it clear that they were not interested in doing a cut as we came into this earnings, or as we came into this FOMC. There was no doubt anywhere. And so that people didn't have to sit out and wait because they already knew what the outcome was. Not a big move through the kill zone. And we haven't really expanded very far from VWAP. We're still inside day. So want to focus on that. We got to get out of the box to do anything else as usual. This is the RTH of yesterday, just the regular trading session. That's the box we need to get out of. You can see the midpoint. So if we do happen to break below the mid, then we want to target the Globex low. It is all the way down here because of this big wick on this candle here right at that 4 o'clock time frame. That's why it's so low. But 69.92 cog line, which is right in here. It's where all of this candles got worked up, right? And it's the same level here. Sure, we were dipping down and wicking through it, but the main structure is on that 92 cog line. So if I just remove this box now that you get the idea of the level that we're talking about, the range of yesterday, you want to focus on if we do get through the half, here's the half. If we get through it, we do want to target the low, but be really mindful of that 92 cog line because it's going to be a significant structure that we may have a hard time getting through. As usual, we want to play it level by level by level, but that is going to be a hard level to get through, right? If we even go down there at all. So that's the RTH. But if we capture the whole thing, all of yesterday, then we can see the half back here. So we need to cut through that, which is basically the 7011 cog line. If we can get through the 7011, then it opens the door lower to the 92 cog. Get below that, and we can challenge the low of yesterday, level by level by level. This white line here is the 3-period daily moving average. We use that for the bull surge and the bear surge signals. Well, you take it out on a daily and look at it right now. We've got a really clean fork. It's that shape and that pattern where the moving averages are spaced apart really well, like a pitchfork. You can see the 310 cross back here. That happens after price crosses through the 3 and the 10. And if it outruns the 10 far enough and fast enough, it'll drag that 3 through there as well and spread them out really nice, just like that. That's the whole shape of a bull surge pattern right there. It's why we like it, right? Because it's an indication of momentum. Short-term trades capturing, short-term gains, really fast play. Bear surge looks the same thing, you just flip it over. The problem is we already topped out and we've started cutting underneath it. So we want to keep our eye on the 10 down here. If things start to get weak and we cut underneath that 10, then we can turn that 3 around and we'll be looking for that bear surge. But it's not just price getting below the 10. It's got to get below the 10 and move below it far enough, fast enough that it drags the 3 through the 10. In this situation back here, we eased our way down through the 10 and we didn't keep it. So the 3 just tangled up. Back here, we cut through that 10 and escaped with velocity below it and brought that 3 along for the ride. Really got it down. As I mentioned, short term, short duration, right? These moves, they don't last very long, but they don't need to. Same thing back the other way. Bull surge. And we tend to top out after that, right? Or we get so far away from the 3 that we start to mean revert. So right now we're focused on yesterday's range. Everything that we want to do today is stuck inside of yesterday's really big range, right? And it's a pretty good size range, all things considered. Big enough. So if we drop back down through the 70.11 cog line, then we've got 69.91 cog line. Then the low of yesterday, which is lined up right on the 10. And if we overshoot that, we get the 1,236. And that lines us up on the 20-day moving average. And there's no reason to think we would get any worse than that, since a 1,236 is basically a typical reversal spot. All right, even though the line isn't there, just because of the way that this platform draws them, we hit the lower ADR last night. If you hit one side early enough in the day, you can go to the other side by the end of the day. The problem with all of this is when the line gets drawn, right? So some platforms will draw that line at 5 o'clock, which is right when the futures market closes. They got to do the settlement and all of that before they open back up at 6. And then other brokers will draw that line at 6 o'clock after we open back up from the settlement period. It doesn't sound like much, but that 1 hour price can gap and be in a different location. So when you look at the lower edge of the ADR, it doesn't really seem like we're capturing the midpoint, but we are. So we've already hit one side. That means we can hit the other side by the end of the day. Usually when we make that comment, we end up hitting this ADR sometime after midnight, right? Like in the European session. We hit it way back here when Australia was still open and we were in with the Asian session. When we hit it that early, we can actually pinball, go to the top, and even come back down to the bottom again. We've done it before. So if we get a chance to check yesterday's high, we'll look for that 111 reversal or the opportunity to hit the upper ADR half. Not looking for any escape beyond that. 1, 2, 3, 6 would be the most I would expect. And if we get there early enough in the day, it still opens 69.88 by the end of the day. Crazy as that sounds. The other side of the whole thing is we're still expecting to stay inside this range today. We have no expectation that we're going to get out of this box other than the reversal, right? So if we break out of the low, I'm planning to flip it over and come back in again. If we break out of the high, I'm planning to flip it over and come back in again. That's my trade plan for today. That's the base case argument. And if I'm wrong, I'll eat it. It's a small loss. And if I'm wrong, that means we're actually really expanding. I'll take that small loss and just turn it over and trade the trend. So what, right? So we'll see what turns out of it. Today's floor pivot is higher than yesterday. That's bullish. Price opened above it. That's also bullish. We ended yesterday without an MDP because we hit it, right? This is an MDP. This is a missed daily pivot. Price never hit it, right? Little Captain Obvious there. This is not an MDP because, well, we hit it. MDP, missed daily pivot, MDP. We don't have one for today either because we've already hit it. We've crossed through it multiple times, so don't expect it to be any form of support or resistance. And with the range of yesterday, it's likely that our S&R lines for today aren't going to offer a lot either. Oddly enough, they're not much wider than yesterday's. Just a little bit. Here's R1 from yesterday, and here's R1 for today. Right? But if you look at the difference, it's not that far off. The base case for today is that we don't go anywhere. We stay inside the range. It does look like the indicator is suggesting that up is more likely than down, but not by a lot. So the distance from the pivot point to R1 and S1 is adjusted by the math, right? They're not equidistant. It's not like this is 20 points, so this is 20 points. That's not how the system works. The distance for each one of those defined by math suggests which way the indicator thinks the market is more likely to go. And it's just the path of least resistance, right? So sometimes it's subtle and there's not much of a distance difference at all. You can't even see it. Other times it's really big and it's really obvious. It's big enough that I see it, but it's not massive. There is more to the upside than the downside. But this indicator doesn't make price do anything, right? This is just a math formula that's calculating yesterday's moves and looking at the high and the low and the close and then just doing some fancy math. So it doesn't influence price. It doesn't make price do anything. Just an analysis tool. We talked about this point of control earlier in the week. with the suggestion that if we was to come down into that level, we'd likely see a response there. And that's what we were witnessing yesterday afternoon, that 69.92 or 69.88, right around that level. And I would say keep your eye on that level. One, it's a cog line, so you should be watching it anyways. But two, it's still a structure. And the more work we put in on the front end here, the more it will build out as a structure. We did fill in that thin area that we had through here. It's not so thin anymore. So this is turning into a more classic D-shape distribution. If we break our value area low, which is really the full low of yesterday, it gets really thin, really fast, and that should get us right down into that 69.50. Remember, we're running 50s. So that's the downside target if we don't flip over at 111 and 1236. If we don't come back in when we break out to the downside, that's the target. And it should be a good 20 something points. So surely we can get, 5 or 7 points out of that 20. It's not asking for too much. $10-day, 30-minute volume profile and TPO. The point of control for both of these are still lined up really well. The volume profile looks like trash. TPO is at least looking better. We've got a nice distribution up in this area here, and then, it all starts to get kind of ugly down here. We're putting in new candles at the level that we're taking them out. So the ones that made this point of control, we're going to be getting into those today here. Now, sure, we've got new ones here, but depending on how much this has to offer, we could see this point of control get moved, and it's likely to end up down here somewhere. That put it into that 69.50 level. It really just depends on how much of this is a part of all of this. So it's likely, we'll see it tomorrow and see where we're at. But 69.92 or 69.50 is where the point of control is likely to go between now and, say, Monday or Tuesday of next week. I'd really like to be above it or stay above it, not be underneath that level. The last thing we need is to have to make another run to the upside and then fight through this point of control. So we'll just keep our eye on it, see where it's at, and what that's going to bode for next week. We did reach the edge of the weekly expected move this week. It took longer than I thought, really. In the past, when we failed to go on the hurry up and wait sideways Monday, Tuesday, into Wednesday, and we begin to expand, we usually hit the edge of the weekly expected move by Tuesday, late Tuesday at the latest, but usually early in Tuesday morning. So I was a bit surprised when it took all the way to Wednesday to get it done, but we did get there. But now we've got this defined range that we need to deal with. And it's a little bigger than I would have liked simply because of that Wednesday afternoon or that Wednesday morning run. But that's the bigger box that we got to get out of. It's one of the things we use the 5x5 for, right? 5-day, 5-minute, just to sit back and get that bigger intraday perspective. There's the range. Now, sure, we got a little bit of trash up here to deal with, but we can see on that volume, we didn't run into a bunch of sellers up here. We just ran out of buyers. Buyers got exhausted. So they've gotten some rest. We've had a bit of a pullback. They're building up momentum. We know that, right? We know when we go sideways that a market, it's like plugging your phone into the charger. A market going sideways is a market that's gaining energy, charging up. And what it's going to do with that energy, well, that's not a part of the equation, right? It's not indicating bullish or bearish. It's just indicating that it's getting energy. But a breakout above this previous high, they'll have the energy behind it, get through that 70.50 and start working towards that 7100. Or a break below that Tuesday low, and we can challenge the low of Monday, Sunday night, Monday. No VPOC for today. We've already cut through that level. Not a lot of value. And there's no insight into the volume profile and the TPO of this morning. Just these micro distributions everywhere. This isn't helpful. It's just garbage. All right, there's the weekly expected move edge that we were talking about. We're supposed to close inside this box 70% of the time. And that means a Friday close, right? So we could still get outside the box and come back in. Simple math says 3 out of 10 weeks, right? So if you was just to count back over the last 10 weeks and ask how many times have we closed inside that box, then you'd know what our numbers are and whether it's more likely that we're ready to do the other side. When it comes to doing those numbers, by the way, if you're counting back, I don't use short weeks in my count. And sometimes, especially after contract changes, this is when we changed contracts. This is where we changed contracts. You can see how the indicator acts a little goofy. It just it doesn't do its job and it just squishes together. Can't count those weeks either. So if you eliminate short weeks and the weeks where it was broken, count back 10 weeks. How many weeks have we closed inside the box? Should be 7 out of 10. Consecutive closes, though, begin to highlight trouble. So if we're less than 7 out of 10, if we're closing in the box 4 out of 10, or maybe 5 out of 10, then it shows that the markets aren't pricing in the volatility, right? The market makers aren't pricing in the volatility. The markets are exceeding the expected move consistently. So like mispricing volatility. Why does it matter? Well, if you go back to periods before really bad stuff happened, you'll notice that we were getting consistent consecutive failure to stay inside the box. Like, say, January of 2020 before the February fall of COVID. We started getting warnings because we were breaking and failing outside the box week after week after week. We had a lot of failures in that time frame. We didn't know what the heads up was. We just knew something was off. Markets were mispricing things like crazy. So it can be a little bit of a tell. We don't have that happening right now, but it doesn't hurt to know about it, to look for it. 1.5% above the 10-week, everything's fine. We haven't got the crossover that I've been looking for. Maybe next week we start that run. I don't know. Either way, we don't have it right now. We're not overbought. That move yesterday on this time frame was not too much. Looking at the daily, we're more than 0.5% above the 10-day. Everything's fine. We're not overbought, not overextended. We didn't move too far, too fast. It doesn't owe us anything, no pullback, anything like that. We're at a good spot. 0.5% above the 10-day is just a really good place to be. With plenty of room, we could make a 1% move even higher, and we still wouldn't be overbought. We start to be touching the edges of a little too far, but even that wouldn't be too much. So we're at a good spot. We're not handicapped by mean reversion at this point. It doesn't owe us anything. Looking at what's up and down in the overnight, my benchmark is 0.5%, simply because of how early we do these. If you're doing this closer to the open, maybe use a bigger number. 1%, 1.5%, 2%. But with 0.5%, tech is down at least 0.5%. Bitcoin, expanded tech, and really that's the two big pieces, right? Is tech and Bitcoin is down this morning. Looking at what's up, I mean there's a lot of what's up, right? What's up? Some of it isn't quite there yet, like XLF, generic finance. Not quite up enough. If you're looking at finance, you might as well look at banks, KRE. That's the one that I tend to pay attention to. And it's not up at all. It's basically flat. But generic finance is up. That's got insurance and trade desks and just all kinds of stuff, right? Uranium, energy, gold miners, communications, nat gas, China, lots of China, Mag 7, UFOs. So we can see the risk in there with the space and UFOs and mags. Uranium, so we got the energy. But if you look at chips, which has been a big driver, they're not up much. They're up. We're not fighting them, but they're not participating. They're not assisting in this push. So we do have enough market breadth for a move to the upside, and we at least have enough that it won't fight us if the indexes want to run to the upside. It'd be that rising tide scenario, right? So it's not too much. I kind of like that. I don't like it if, if the mags are already up 3% before the market even opens. It doesn't really leave much for us to run in the intraday. So I like that they're not up too much. But keep your eye on it because it's also up just enough that it could flip on us. That'll be easy to see anyways, so I'll take the tell. But keep your eye on market breadth this morning, how much we have as we get into the open, and then whether or not we start to lose it as the morning goes on. There's a way I like to gauge things in the pre-market. Usually when we're bullish enough or bearish enough that we want to be able to put a number on it. So this screener is the S&P 100. I use the 100 because then we can use percentages in our answer. How much of the S&P 100 is up at least 0.5% this morning? 21. So 21% of the S&P is up 0.5%. That's not bad, but that's not overly bullish yet, right? And then when we look at that, well, what space, what industry, sector, subsector, what's up, right? Because if it's Caterpillar and John Deere and Home Depot, then, maybe we don't give a damn. Because those names aren't going to give us a breakout and a rally day. But if it's financials and it's the Mag 7 and it's chips and communications, and those names can assist with a breakout and a rally day. If it was heavily influenced, say 80% or 90%, then it would stand out, right? It'd be extremely bullish or extremely bearish, and we'd be able to see it without squinting. So looking at the NASDAQ 100, 23 names, that's 23% of the NASDAQ is up at least 0.5% this morning. And again, in the same thing, you can look at the industry or the sector and see what space. I still see a lot of those memory names, right? Seagate, Western Digital. Memory's been a really big deal lately. %12 of the S&P is down 0.5%. We can keep your eye on that number, see if it starts to climb. And then, of course, same thing with the NASDAQ. 22% of the NASDAQ is down 0.5%. Well, isn't that telling? The advancing minus the declining issues in the NASDAQ is nearly equal in the pre-market this morning. Well, that'll be an easy market breadth to keep your eye on, right? So gold, oil, silver, so precious metals, uranium, solar, goodness, really anything energy related is up this morning. And then the mags, and then the banks, well, not banks, finance, and then China. And there's our chips trying to come in, trying to be relevant. They're just not there yet. So we got it. We got everything we need for a rally day. We just got to have some trigger or macro firing that gets everything going, right? What's the primer? Nothing that we saw in the data for today. We don't have one. It doesn't mean that we can't get one. Any headline could suddenly become the primer and we just take off. But at the moment, we don't got it. So without it, we could slow grind and, get outside of yesterday's range and just keep right on going. But again, I don't believe it. Gonna have to show me. So I'll be looking for the reversal if we even get to the edge, right? That's a big if, because there's no reason to believe we're even going to do that. There is this distance to the floor pivot to worry about. That's the weekly floor pivot. If we did get a breakout of yesterday's high, how much farther can we get away from this week before we've gone too far and we have to turn around and come back? It's another argument to take the reversal if we do break outside of yesterday's high. So that's what I'm going to be looking for. It's a simple enough day, right? We got easy levels to the downside, easy levels to the upside, and we're stuck in the middle of the range. So all we got to do is wait for a breakout. That's what I got, guys. Be careful, be safe. Have a good day. I'll see y'all tomorrow.